All right, good morning, everybody. 6:31 on Wall Street. Good morning. 3 hours before the opening of trading. Um, well, it's time to get our macro on. Let's do our QuantBox live. My name is Wayne McDonald. I'm the founder of QuantBox. I built it because I needed to automate all the hard work. Lots of hard work, lots and lots of work. You know what? It's very cool to be able to plug directly into the databases of various government agencies and other private databases and grab it and pull it in and organize it, smash it all together and make logic out of it. So you get lots of pretty colors. For those that are colorblind, that's the color of money. Yeah, very cool. So anyway, so we drill into the fundamentals and we organize our thoughts by comparing various assets, or we look at the flow of capital. This is what the Commitment of Traders report looks like. And yes, we actually look at the Commitment of Traders report. This will show you where the money is and where the money is flowing in and out. Not dumb money, smart money. So it's really nice to know all of this stuff. So if you swing on by QuantBox, you can take a test drive for $8. And included in that is a macroeconomics training course, but it's only 16 hours long. And another one on statistical analysis. But here's the thing. Here's the bottom line. It's going to give you confidence because you're going to know why the market is moving. It'll make logical sense to you. And therefore, you'll have the confidence to let your winners run. That is the ultimate value. QuantBox does amazing things and it pulls all the data together and organizes and crunches and all that. But ultimately, it gives you the confidence to let your winners run because you know why you're trading. So, for example, euro dollar, QuantBox does comparative analysis of GDP between the two economies, inflation between the two economies, unemployment between the two economies, interest rate differentials between the two economies. It looks at smart money and dumb money. So retail in this particular case, at this particular time, was 73% long and 27% short. But look at institutions. It looks at technical analysis. It looks at seasonality. And then it scores them and organizes them so it all makes sense. And then makes 7-day projections, base case, worst case, best case scenarios, all with statistics and facts, not some idiot guru on YouTube making predictions. Oh, is that me? Anyways, so if you are watching this on YouTube, swing on by. This is something special, something that you need, the thing you've been looking for. So, with that being said, let's get on with it. Let me remind you that trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. Please stay small, stay humble, focus on the long term. Never risk money you cannot afford to lose. Bernd wants some information on gold. You bet, buddy. We'll do some gold. All right. Let me log into the correct, I have to have the correct account to log into the Google Cloud. Remember, QuantBox is not a website, it's a database. So all this is live data. Load in, load in, load in. Okay. Yeah. All right, cool. Whoa, look at the yield. It's just crazy, that yield. It's amazing the last 3 or 4 months when I log in, this is where my eye goes. Just boom, straight there. And typically when that's going up, okay, amazing. You know, so you get, well, let's reverse the whole thought process. That bond market, that's a treasury, and prices are falling, and they're falling hard. People are very concerned about this. There's lots of different ways of looking at it. One, it's probably quantitative tightening or somewhat affected by quantitative tightening. Because think about it, the Fed is actually selling bonds. Well, there you go. There's more sellers than buyers. They're going to dump another $4 trillion of these treasuries. Now they have longer dated, they have 10, they have 20, they even have 30. So that's kind of interesting. So they're shaping the yield curve control or shaping the yield curve. But then also, this is the market trying to get things organized. I mean, there's a lot of things going on. The market's trying to figure out when is the Fed going to stop, right? What's the terminal rate, which is when is the Fed going to stop raising interest rates? What's the neutral rate? Like, if the Fed gets interest rates to two, I mean, inflation to two, let's say 3, 4 years from now, let's say the Fed is successful getting inflation down to two, what would the Fed funds futures rate be? Traditionally, it's about 50 basis points higher than that. So 2.5, that would be normal. I think people are thinking 3.5. And then there's risk of investing 10 years by buying a 10-year T note because interest rates over the course of the 10 years could change and adversely affect your investment. So there's a risk premium. And then you calculate all that, and what do you get? 5%. So, anyways, we're on our way there. And I wonder if it's the new normal. Like we stay at 5% for a very long time. Who knows? We'll find out. Oil stabilizing at 88.88, eh? Yeah. Did we get a whole bunch of new oil? Is that why it's down? Just a whole bunch of new oil just showed up? No, so there's a bit of a fear of recession. The thing is, and this comes up all the time, doesn't it? Are we going to go into a recession? We already know. I haven't made this point in a long time, but maybe let me get let me get off the speech. Let me go. Let me just move with it. We already know. Thank you, QuantBox. Here, and we'll go to the Fed. Okay, what does this tell us? The Fed's cutting interest rates the third quarter of next year. So about a year from now. What does that mean? We'll be in recession. Like we've known this for so long. Yeah. So according to the Fed, we're going to go into recession next year. It's all by design. Sweet. Probably very mild, but nonetheless, isn't that the whole point? So, anyways, I mean, there it is. They're cutting. Why? Because everything, right? Because the stock market, because the economy is booming? No, they're going to be cutting because it's slowing significantly. I think that's what we call a recession. Okay. Anyways, so we already know all of that. Okay. All right. So, anyways, oil coming down. I still, I think I'd be a buyer. I think I'd be a buyer, but we have to look more specifically. Gold has come down quite a bit, down another 1/3%. We'll take a look at that more closely. We have a request. It's another benefit of attending live. Thank you for attending live, everybody. S&P 500 stable. It's the only thing stable. Everything else is coming down hard. Dollar's been ripper strong. Stable. Cool. Okay. All right. Euro dollar. Well, we were farting around what, 108, 109 recently? Here we are at 105. Wow. Bitcoin. Uh, it looks like a devastatingly poor day, but we were at 25 recently. Now we're at 28. So you want to take a look at that at a bigger view. When you zoom in here, the trend in the global stock markets is down, 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 down. Very much risk off. Okay. Anyways, Take a look at the scatter plot. Now let's do risk gauges and then scatter plot. Nothing has really changed dramatically. Ever so slightly risk off, mixed. Well, that's how it's been for the last multiple days, right? So no big dramatic. And this is really helpful because sometimes everything feels crazy, right? And it's because the human mind is fairly simple. We grab onto a couple of things and then we extrapolate from that and say everything is good or everything is bad. Well, the world is a little more complex than that, right? So it's nice to kind of pop your head out of the hole like a meerkat and look around once in a while. Yeah. So anyway, so we pop our head out of the hole and say, okay, so gold is down. Okay, not so bad. Futures are down. Okay, so these are good things. 10 yield on the 10-year T note up. That's significant. Okay, -1. S&P 500 down 5.3% over a month. That's a pretty bad month. So we score that. Okay. VIX is way up. Holy, but we knew that. I mean, seriously, we're talking in July, like, VIX is gonna fall. It's gonna fall until September, and then it's gonna pop back up. We already know all these things. I mean, I was exposed and to this happening, and before it happened, I rotated out of that exposure. Now it's really, really high, and I'm thinking about maybe taking on some of that risk. I might be able to profit from this. So, but high volatility is bad for the market. So we're going to score that. The dollar index, okay, the dollar's strong lately. It's quite strong. Okay, and that's a sign of risk off. So when you look at this, you're like, okay, it's fairly balanced. It's not terrible. Okay. It did this because we're only looking at this one and it messes all of this up. There we go. So look, it's not that bad. It's not terrible. It's not that great either. If you're crushing it, you're buying some dollar or something. Great, cool. But ultimately, everyone should realize it's not that good or bad. So, right, be careful because we tend to see what we want to see. Like the meerkat in the hole loves his den, right? It's beautiful. And he looks out the hole and he sees the sky and there's his world. But when you pop out of the hole, the world, you see a whole lot more. So every once in a while, you got to make sure you see everything so you understand the real world around you, not just your fears. All right. Cool. Just we have a request for gold. Let's start with some seasonality. Okay. And gold, you're supposed to sell sort of like in that August period. Okay. And from August to September to October, it's generally bearish. And then stabilizes way out in November and falls flat. Okay. So a down month, down month, down month, flat up. So it should be down. Okay. Should be down. And it is down. Good. Great. Fine. Okay. So we know that. We can also take a look It's under bonds and commodities. Okay, this is the same thing, but I'm just comparing bars instead of putting in the line. So it's supposed to be down, and it is down. Okay. Next month is less down, but down over 20, 30 years. Yeah. But over the last 5 years, it's popped up. It's actually been a positive month. Well, that's now you have to say, what are you trading, 20 years or 30 years? Well, you make that decision. Okay. When we look at it, technically, it is bearish. So you can see it uh, with this subtle clue. The subtle clue, where's my drawing tool? Is here. Bearish. Okay, so anyway, so technically, so we can look at it. Let me get a different color. I guess blue. There's not a lot of blue here. Okay, QuantBox is looking here. So that's calculating the average. It's also calculating the rise over the run. It's calculating the variance, which are the highs and lows from the mean. It's taking the square root of the mean and calculating the standard deviation to standardize the variance. So you get these. And then the slope is important because then we can project into the future 7 days based on that slope, which is rise over run. Cool. Formula just for everyone, y equals mx plus b. Sweet. Okay, cool. Plus the variance plus the standard deviation. Great. So in that case, the worst case scenario in a down environment for gold to continue at this pace, 7 days from now, we'll be at 1837. We're currently at 1841. The base case, 1798.74. So we're on our way to 1800. Best case scenario for a bear, 1760. Okay. Yeah, and of course, this ain't working. Gee whiz. What's going on here? So, anyways, these should match. Wonder what number it's pulling for that. I'll have to yell at somebody for that. 18. It's nothing on here. 1805.23. 1805.38. That's close. 18 midterm. Wonder if it's only projecting like 5 days and this is projecting 7 days or something. Anyways, I'll have to yell at somebody. I'll have to make time in my busy day to yell at somebody. All right. So what else is going on? Retail investors are 73% long. Cool. Okay. Even institutional investors are long. But I think if I recall that it's less long than before. So now you can go to we can go to the COT data. And see institutional investors are quite heavily long. But you can see there are 17,000 new institutional investors short gold than before, or at least contracts. I mean, I doubt one company. So the market, when you add up all the contracts, okay, is more bearish than it was before. But we know from seasonality that totally makes sense. We can also see here that gold has 2,000 less bullish contracts. So there are less bulls and more bears, which makes sense seasonally, doesn't it? So Burton says time for a short squeeze. So you're going to look at all this and buy it? You do you, man. All right, you do you. Doot-da, doot-da, I mean, it can be interpreted all kinds of ways, huh? So then we can look over and take a look at it from technical analysis point of view. And we've hit this target, which I've already pointed out. Let me get rid of some of this stuff. I already pointed this out quite a while ago. I guess, around 1900. I think we started talking about a fall to 1800. And I'd say roughly that's happened. Those are rough numbers, obviously, but look, I mean, look, there it is. Then you draw it over here. And so we zoom in a little more closely, and look, we've hit that number. Yep. If we're going to adjust this, let me adjust my daily pivots, price action pivot points. Interesting, I have it twice. Bias pivots. Okay. So the idea here is up, then probably down, like that. Let me zoom in. Okay. So this line, this fat orange line, is actually this line in the future. That's what I was trying to do. It's a predictive moving average because the moving averages are lagging and we're trying to ride the 21. Notice that over time that they tend to converge. So anyways, cool. 1835 is your number. So you're buying to counter trend trade short term. Wow, is that risky? All right. 1816 going to 1835. Wow. All right. Well, good luck to you, Bert. Stand in front of a freight train. Okay. Be careful, my friend. Yeah. Be careful. That's all I'm saying. Just be careful, man. You're buying something that is obviously falling, and then you're getting out of it quickly. So you're taking all that risk and you're not making a lot of reward. I'm like, be careful, man. Be careful. That's all I'm saying. Be careful. My WTI. I guess we got to just jump into that. Okay. Thing is this, what does this represent? Does this represent that the market has determined that the US is going to go into recession sooner than later? Maybe. Maybe this is the strong dollar. $1 buys more oil now than a week ago. Well, that's plausible. The dollar got strong. Okay. So interesting. As it gets closer to 85, probably want to buy this. I know you're not really asking me. I'm kind of telling myself, like, because one thing I do know is there's not much oil. So we'll have to take a look at that. Oil inventories come out tomorrow. So right? Today's Tuesday, right? So I guess then we can update our price forecast based on inventories tomorrow. So if tomorrow's Wednesday, then today is Tuesday. Sorry, I only know the day of the week by the news. So if tomorrow's oil inventory, then today must be Tuesday, and that would make jolts. So we must have jolts today. Tomorrow at 10:30 we would have those oil inventories, but at 8:15 we would have ADP. And then for a 10, probably ISM. Am I doing about right? Sorry. but I struggle knowing what day it is, right? But the news flow. Yeah, yeah. All right, cool. So anyways, Jolt should be interesting today. I don't know if it'll move oil, but so anyways, what I'm thinking is um wouldn't it be interesting if this just plays out this way? Okay. This is just the market not quite ready to get to 100. Okay. But I don't believe its oil inventory is going up, meaning if supply goes up, then prices fall. So something else is right. Something else is going on there. All right, cool. Yeah, dollar was strong. I'll show you these exotics. Okay. And here's a really crowded trade. So lots of people watching this one. Okay. Okay. So that is the three most important prices on this chart are these three right here. Okay. Because in this zone, this is where bulls buy. And in this zone, this is where bears sell. And it looks like bulls bought, and there are more bulls than bears. Yeah. That's just it. That's it. Right? Because think of it this way, there's going to be a lot of oops, let me use my drawing tool. Delete. All right. There's going to be a lot of selling orders here, and there's going to be a lot of buying orders here. Think of it that way. And these guys got just, there's just more. That's all it is. And at some point, for those that sold here, where are their stops? Their stops are up here, right? So if it keeps going this way, you don't need more bulls. Okay, so bulls bought, they're done. No more bulls. That's it. No more bulls. These have sold. Then they're like a wimp. They start wimping out. Every time a bear wimps out, okay, the market moves up, which makes more bears wimp out. And then for those that don't wimp out, they get stopped out. And the whole time you don't actually need more bulls. It's just less bears. Okay. Anyway, so the top end is 18. Okay, on the longer run, this is very important because it changes a trend big time. This was a huge trend, huge. Okay. And it might be dead for quite some time. And this is probably an example of traders trying to get in last year's trade, right? Or an old trade, an old trade that doesn't exist anymore. Which one do I want to do here? Pull that in a bit. What do you think? Is that the new trade? Yeah. Yeah, very possibly. Very, 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 very possibly. So it's easy to get into habits. Very easy to get into habits. So this is why we do our analysis over and over and over again. That has been a very good repeatable trade over long periods of time. It may be over. So at least be cognizant of it. Maybe it'll set up again over the 200 EMA and that kind of stuff. But right now, this market, I would mark it as neutral. That's what that 200 EMA represents to me. Okay, neutral. Remember in my book, I talk about below the 21. So, like in this kind of area, you're bearish and aggressive. Okay, then you test the 55, you're bearish and conservative. Okay, above the 55, you're probably going to snap back to the neutral zone. Okay, it doesn't always work that pretty, but that's what's in the book. And in the example, I talk about an archer drawing on the bow. The farther away you are, so when we were at that point, let me get rid of this. When we were at that point, we were a million miles away from the 200. So the farther and farther and farther away that you deviate from the 200, the more it wants to snap back. It's like drawing, 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 drawing. And there's more and more and more and more and more tension. Okay. And so, anyways, that triple bottom, higher, high, higher, low fulfilled its destiny. Now we're at the 200 EMA, and I don't know anything about nothing. It's neutral. How am I supposed to know whether bulls or bears are going to take over? I don't know. Now, watching the flow of capital, maybe on a commitment of traders report, will show you that. But right now, it's neutral. Okay. Money has been flowing into South African rand. It doesn't look amazing today or yesterday, so maybe it's dead. Maybe it was just a blip in the matrix, or maybe this is what's in play. All I'm looking at is this. Okay. We call that eyeballing. Did I calculate the variance and then take the square root and then calculate the slope of the mean and then do a linear projection? No, we call it eyeballing, right? Eyeballing. But it's amazing how I said earlier how simple the human mind is, but we're also complex in the fact that we see patterns. So we don't know how to do the math. Many of us get squirrely when we bust out the math, but you know how to do the math inherently. Not always, but you can do a linear projection that way without having to do the math. Maybe. Okay. Cool. Anyways, euros are still technically trending down, but slowing. Moving average is not really helping much anymore. Look how beautiful it was earlier. Okay. Uh-oh, that's a bad sign. And then once you drop below, that means we're going back to the neutral zone. Okay. Okay. And now it feels toppish. So, right? So, anyways, I feel like I've gone too long, so let's call it a day. Jolts, baby. Don't forget about jolts. It's going to be the catalyst of the day. We want to see a little less jobs, and we want to see a lot less jobs advertised. That is bad news, and that means it's good news because then the Fed doesn't have to raise 10 more times. Maybe one more time is enough. But we already know that. But the rest of the world doesn't. Okay? It's dangerous being smarter than the market. So don't try to be smarter than the market. You have a lot of data with QuantBox. The trick is to be patient to allow the market to catch up. So we already know a lot of these things. It's already plotted. We've known it for months. But do you remember when I go through the Fed Watch tool and they're pricing in cuts and I'm like, they're totally wrong. And then they right? Then they price the cuts out. Then they price in the cuts at a different time. I'm like, they're still wrong. And there's a level of arrogance to saying, like, how could all these institutional investors be wrong? They're smart money. I'm like, I know, but they're wrong. I can show you the data, and that's why QuantBox is so powerful now. Where before I try to like explain it, now I can just show you. Even institutional investors get it wrong. So it's our job to know the facts and then be patient enough to wait for the rest of the world to catch up. At first, it'll be institutional investors, and then later it'll be retail traders. And once retail figures it out, we should probably start taking profit. So right now, it's like the institutional investors are still pricing in rate hikes. Wow, really? Well, cool. So then the next thing that you and I need to watch is not just the stock market, but these yields. I think there's going to be an interesting way to make money. Probably not till the end of the year or early next year. But those bonds are going to get interesting. Remember, the bonds are falling and falling and falling and falling and falling and falling and falling in price. At some appropriate time, those prices will be quite low. Okay. Now imagine risk-free money right now pays you 5%. Short term, risk-free. You don't even have duration risk. You can buy what, a 2-year. You have very, very low exposure to risk on a 2-year, and it pays you over 5%. This is probably what's holding back on the stock market, right? So you're not so sure the stock market's going to go up 10%. You need it to go up 10% a year. You're not so sure this year it's going to go up 10%. Or you're worried next year it won't go up 10%. Well, it'd be interesting to lock in a risk-free asset that gets you almost 6%. I mean, think about that. Like another reason the bond market's falling, we have all these things, what we call shadow banking now. So, like, you don't even need to buy a 2-year treasury. I mean, most people don't go out and buy a 2-year treasury, right? Give me that 2-year note, right? And people just don't do it. So, what are they doing now? If they're not buying bonds, what are they doing? You just put your money in a money market. Or your broker just says, leave it in cash and I'll give you 6%. There are brokers out there. I've heard the advertisements on Bloomberg and CNBC, and they're like, on all your tradable cash, we'll just pay you 5%. You're like, that's not a that that's not a treasury, but they're paying you treasury like stuff, huh? So it's pretty amazing to like your cash is earning 6%, risk-free money is earning 5 or 6%. So when the Fed is done, and the Fed has told us they're done, or at least the world believes the Fed has told them they're done, won't it be interesting to see what happens to that short-term money? Somebody might just gobble up all that opportunity, and those short-term yields fall. The long-term yields now look like they're rising. They're inverting relative. So could be interesting because that'll people might move their money right now. You can't buy a money market that pays 5%. So maybe you're better off just buying stocks again, huh? So it's our job to figure all that out. When is that going to happen? Cool. Today? No, probably not. Cool. So, anyways, so we covered a lot today, specifically gold. Burned requested that, so that was done. And for everybody else, have a wonderful day. I'll see you later, I'm sure. Peace on earth. May the pips be with you. May your profits be above average. And remember, let your winners